All right, welcome everyone. Today I will talk about what is financial hegemony and how does it end. And the context is that we are in a period of quite rapid and unpredictable change in the international monetary and financial system, where the US has for the last 100 years been the uncontested financial hegemon. How do we know that financial hegemony ends or transitions from one power to another? Well, I'm giving this talk here at the LSE in the middle of London. And London, of course, and Britain was the financial hegemon until the US took over during and after World War I. And before that, there were various other financial hegemons. So here is the outline for the brief talk today. We'll start with the question of definition, or how we can understand financial hegemony. And there are two perspectives. One is, what does it mean to economic actors outside the United States? So here you see a map of the world in the background of this slide. Without the US. So non-US economic actors, and that comprises households, firms, and states, they have to pay for a lot of things in dollars. A lot of international trade is invoiced in dollars, so the US dollar is the dominant invoicing currency. They also have to, or want to, borrow in dollars, which makes sense. If you have to pay in US dollars, you also often need to get a loan in order to pay for your obligations. So the US dollar is also a funding currency. And finally, governments keep their official foreign reserves in US dollars, meaning in US dollar denominated assets, especially first and foremost, US government bonds. So the US dollar is also a reserve currency. And together, these functions being performed by the US currency, this is a solid foundation and manifestation of the US's reserve currency and status, which underpins its financial and monetary hegemony. From the US perspective, financial hegemony has a number of advantages. US economic actors never have to worry about obtaining foreign currency because they can always pay in US dollars, or at least almost always. They can also borrow relatively cheaply from the rest of the world because the rest of the world wants to hold these US liabilities, these US bonds, and equities. And as a result, the US can consume more than it produces. The US economy can import more than they export on a very sustained basis. We'll see about that in a second. So what has financial hegemony ever done for us or for the US in practice? Here at the beginning, you have a brief reminder about what the current account balance, which you hear a lot about in the news these days, because Donald Trump and his administration are quite obsessed with the US's current account deficit. So the current account balance is the trade balance of a country, exports in goods and services minus imports of goods and services, plus the primary income balance. Primary income balance is not so important for today. That's the income primarily from foreign investments minus the payments you make to foreign investors on their investments in your country. The US has maintained a persistent trade deficit for many decades. The primary income balance has remained broadly balanced, which is its own astonishing feat. But we won't go into the details about this today. And as a result of this trade deficit, the US has run a persistent current account deficit. That means that every year the US has to borrow from the rest of the world to finance that deficit. Borrowing means selling financial assets to the rest of the world, bonds and equities. And the result is, the consequence is a growing pile of foreign liabilities from the US perspective. Now, that sounds bad, but it's actually a big advantage. Most other countries can do this only for so long. At some point, other countries won't be able to borrow from the rest of the world anymore because the rest of the world will stop lending to them and they have to balance their current account. They have to reduce their imports and increase their exports, become more competitive, lower their living standards by reducing their exports. Okay? The US have not had to go through this adjustment. This is not necessarily what economists expected in the past. There was always the idea that the US too would have to rebalance at some point, that no one could shop that no one could shop without ever dropping, but that's what the US have been able to do. So just a couple of examples from 1999. The US Secretary of the Treasury at the time, Robert Rubin, said that the international system cannot sustain indefinitely the large imbalances between the US and its major industrial trading partners. This was a ubiquitous view at the time, held also by various very senior economists. Their quotes are listed here too. Now, if we look at the data, we see that the US trade balance, which is the orange columns here, and the current account balance, you see that the trade balance accounts for the large majority of the current account balance, did indeed reach, or was indeed close to its all-time peak in 1999 and 2000, which is when these quotes, these statements were made. However, it continued to increase until roughly the onset of the global financial crisis in 2007-8, to reach an all-time high of above 5% of GDP. The vertical axis is percent of GDP. After that, after the global financial crisis, the US current account deficit declined somewhat, but has since stabilized on the very same level of where it was in 1999 when these statements were made. So reports of death by trade deficit have certainly been greatly exaggerated in recent decades. So this mechanism whereby the US can continue to sell financial assets to the rest of the world, can continue to borrow, very much continues. And here you can see the cumulative consequences of this foreign borrowing over time. Borrowing means selling financial assets, which become US foreign liabilities. Here you see in this chart, above the zero line, you see the US's foreign financial assets, not so important right now, and below you see its foreign liabilities. The solid line here is assets minus liabilities, which is the net international investment position, which currently stands at negative 25 trillion US dollars and is approaching 100% of GDP, approaching. US GDP is above $30 trillion. You can see the various categories that you can decompose these foreign assets and liabilities into various categories, of which the most important ones are portfolio investment, foreign portfolio investment in the US, equity, that's the gray area, a steadily growing part of the US's foreign liabilities, especially because this increases both because the rest of the world has kept buying more US equities and also because US equities have steadily gained in value. So this is both a quantity effect and a valuation effect. And then the second category in pink is bonds. That's in particular government bonds, but also corporate bonds and so-called agency bonds. So of the Fannie Mae and Freddie Mac mortgage-based bonds. And then you have foreign direct investment and other in green and blue and derivatives. The US have been able to continue to borrow from the rest of the world because the rest of the world really has an unrelenting demand for these assets, both safe assets, which are particularly attractive to foreign reserve managers who manage their country's official reserves. They want safe assets, and US government bonds are the dominant safe asset in the global financial system. It's simply the largest liquid financial market is the market for US government bonds. And there is also unrelenting demand for US risk assets, meaning US, the shares are issued by US companies. Now, which factors support this financial hegemony? We could talk about this for a lot longer, but I just want to briefly mention the main points. There is, of course, military dominance, okay, which very much continues and has been a feature of the global, has been a feature of international relations more broadly ever since the end of, ever since World War II, and to some extent even before. There is economic dominance. Economic dominance has declined relatively, in relative terms, maybe faster than military dominance, just in the sense that as a share of global GDP, the relative size of the US economy relative to the rest of the world has fallen, especially as the Chinese economy has grown very fast in the last few decades. Then there is also legal dominance. This means that a lot of financial contracts and a lot of large parts of the financial system run on New York and to some extent London legal foundations. This is detailed in Katharina Pistor's book, Code of Capital. And then there are soft power factors. There is trust accumulated over many decades during which US assets have served as the foundation of international investors' financial portfolios all over the world. And so there is a very important element of trust in the global that determines which, or there's an important element of convention and mutually shared expectations among financial investors that can, of course, shift potentially relatively quickly, but in practice it takes a lot to unmoor such trust and expectations. So all of these factors continue to underpin US financial hegemony. But what if these pillars got undermined? We are certainly in a moment in history where it is important we as international political economists ask this question. Who or what may be undermining these pillars? Well, first and foremost, it would be the US government itself. And how do they do that? The leading theory and the leading concept in this context is the weaponization of interdependence, which is a concept coined by Farrell and Newman in 2019. And the idea here is that the US, the entire world depends on infrastructures that are run, maintained, and often owned by the US. And in the financial realm, this is, for example, and most importantly, the US banking system. So in order to make a payment in US dollars, anyone, anywhere in the world needs to go in one way or another through the US banking system and eventually even through the balance sheet of the Federal Reserve, the US central bank. And so this gives the US extraordinary ability to sanction states, firms, and even individuals by excluding them from this international payment system. It's very tempting to use this power, and the US has been increasingly using this power in recent years to sanction countries such as Iran and Russia, but also firms that have been caught doing business with these sanctioned countries, and then even individuals such as certain oligarchs that are deemed close to Putin, and so on. So the reach of this sanctioning power is kind of unlimited. The rest of the world, however, learns a lesson from this, potentially, because this is a very fearsome power held by the US, and if Donald Trump and his now second administration increasingly are increasingly willing to reach for this power to coerce not just adversaries, but potentially even in the future allies, then those adversaries, and potentially even allies are going to increasingly look for greater monetary and financial sovereignty and for alternatives to the US-dominated parts of the financial system. For a long time, there were no such alternatives. There were no other currencies that could credibly serve as reserve currencies. There were no large enough financial markets into which reserve managers could diversify out of US dollar assets. But increasingly there are, and of course the euro is an important game changer in that regard. It took a while for the euro to become a more viable alternative for reserve managers, but certainly its share has increased in recent years. And then there is the Chinese renminbi, and the Chinese, let's say, sphere of economic influence has been growing. The renminbi is increasingly used as an invoicing currency, and the Chinese government is supporting and fostering this development. So to the extent that there are increasingly more alternatives, actors outside of the US will increase their efforts to make themselves less vulnerable to this sanctioning power. What would we expect to see if there were cracks in the edifice of US financial hegemony? Well, recall the indicators that we went through at the beginning. Economic actors outside the US pay for things in US dollars, so we would expect to see a declining share of the dollar in invoicing. They borrow in dollars. We would expect a declining dollar share in global borrowing. And they keep their official reserves in dollars. So let's just have a quick look at this last indicator, reserve holdings. So here I show you data from the IMF about the volume and composition of global official reserves held by all countries together, split up here by currency. And in the first panel you see absolute numbers, the absolute composition of global reserves, and you see that those numbers have surged from just about $1 trillion in 2000 to about $12 trillion today. And in the second panel, you see the relative composition. And you can see that the US dollar still accounts for the majority, okay, about 57% of these global reserve holdings. Global reserve managers still keep most of their reserves in US assets. However, that share has steadily declined from around 71, 72% in 2000. And the difference has been made up by growth in other currencies, especially Australia, Canada, Canadian dollars, Chinese renminbi, the euro, the Japanese yen, and the pound. These are the other important reserve currencies. All right, and then we can look at this. This is the long-term view, and then there is a time series from the Federal Reserve, where we can look at on a weekly basis how foreign holdings of U.S. Treasuries held directly at the Fed develop week by week. And here we can see that since April, okay, and this recent peak here is around the day of, is around Liberation Day, when Donald Trump first announced his tariffs. Since then, there has been quite a significant decline of these treasury holdings at the Fed, from about $3 trillion to 2.75 trillion, which, you know, this is a very compressed, zero is still very far below here, but it's still $250 billion, so it is a significant decline. These things move slowly, so we shouldn't read too much into that, but it's certainly noteworthy. All right, let me just conclude with a quote by the U.S. Treasury Secretary Scott Bessent, which he uttered last year before he took office, before the election, during a conversation or a panel, where he said, "Tell me what all the former reserve currencies have in common. They were also security zones. How did they lose reserve currency status? Well, they got highly leveraged and they could no longer support the military." So this is Bessent's reading of the literature on the history of monetary and financial hegemony. And he mentions explicitly Portugal, Spain, the Netherlands, and Britain as the predecessors of the US in this regard. And I'll just conclude by noting that it's interesting, and probably not without reason, that the future US Treasury Secretary was wondering last year about the financial and economic and political mechanisms that drive hegemonic decline and hegemonic transition. We should all keep looking out for these mechanisms. Thank you.